Okay, welcome everybody to today's webinar on how indexation impacts strategic considerations. It's so that sort of that time of year, and I think look, the reality of indexation is that, and as I'll go through in today's webinar, is that it's something that's always been around. We see most things or lots of numbers indexed on an annual basis, and that'll continue to be the way it plays out. And we're sort of now seeing more regularity with regards to indexation of both the general transfer balance cap and the concessional contribution cap, which of course has flow-on effects to the non-concessional amount. But what it means is because these amounts aren't aligned in their indexation, so they don't necessarily index in the same year, it leads to or creates some anomalies with regards to strategic planning that we have to take into consideration. So I find it quite beneficial to be able to talk about indexation and understand what it means, how it works with regards to the various thresholds. So then if there's a need to explain things to clients with regards to why you can do this one year and not the next or whatever, or the impact of something changing, it's good to have a good appreciation for all of that. So that's the focus on what we'll look at with today's session. We'll work ourselves through how indexation is going to impact a number of strategies. So we'll look at indexation with regards to income streams, indexation and contributions, and then indexation of the age pension and Commonwealth Seniors Health Card. So the first two is how the general transfer balance cap particularly impacts things versus just standard indexation. And we'll talk a little bit about a number of the other index factors, including the likelihood of seeing the limited recourse borrowing arrangement rate drop, subject to what the numbers will be released in May. So reasonable amount for us to get through today with reference to the various numbers, and I'll talk sort of in concept from a strategic point of view with a number of these key issues. So firstly, let's look at the general nature of indexation, because it's fascinating in the sense that as much as superannuation can be fascinating, but it's fascinating in the sense that having worked in the superannuation industry itself, inclusive of my time in the tax office, I'm coming up to over 30 years. I'm not coming up to, I have surpassed 30 years. And my introduction came in regards to when the Super Guarantee was introduced. So Super Guarantee was introduced in 92, 93, and that resulted in sort of the tax office expanding and creating a superannuation business line, and that occurred sort of around that 1994 time. So I've been working in the space, and of course indexation has been a key element of 30 years of my life with regards to, firstly, the Super Guarantee, which was indexed legislatively, but also other things like the low rate threshold, which of course we saw come to an end last year when preservation age hit 60. We saw no further need for the low rate threshold. But along the way and over that 30 years, we've seen a number of factors that have come in and disappeared. Surcharges is certainly one of them. You've seen others that have remained relatively constant with regards to at least their introduction, but have gone through some changes themselves. And what you've also seen is a number of factors and thresholds that have been introduced that have never been subject to indexation, despite perhaps there being some potential benefit in seeing those amounts indexed. And for me, the classic one there on the right-hand side is the small business retirement exemption. So of all of the thresholds that exist on that table, that small business retirement exemption of 500,000, when that came in, it was set at 500 and it's never been indexed. Of course, the CGT cap, which we see on the left-hand side, is indexed every year in line with average weekly ordinary times earnings. And so we have to appreciate and have an understanding for how the retirement exemption sits within the CGT cap. So one side of the equation is growing, the other side, being the retirement exemption, is not growing. And of course, the irony of the naming there is that the retirement exemption itself is not linked to retirement, whereas the 15-year exemption, which is how you can contribute under the CGT cap, is pretty much exclusively linked to retirement, with the exception of disablement. So, there's some significant elements there, but we see it, and probably the one that's become the most topical in recent times is the concept of disregarded small fund assets, and the $1.6 million being introduced at the same time as the general transfer balance cap, and being a way of isolating or identifying how much you could put in to a retirement phase income stream to be entitled to the exempt current pension income. The end result of that disregarded small fund assets amount not actually being indexed legislatively and being fixed at that 1.6 has always sort of been quite intriguing, I think, from an industry point of view. So we've got the thresholds there. I'm not so sure how many of you saw the press release or the announcement this morning, and we see this pretty much this time every time there's an election. But the Grattan Institute made some commentary around how they feel the superannuation system should be fixed. I suspect that most people tend to disagree with a lot of the numbers that they come up with. I see that one of their thresholds was that they wanted to see the Div 293 threshold reduced from 250 down to 200,000. They wanted to see, I think, the abolishment of the unused carry forward amounts. They wanted to see the contribution caps reduced back to 20,000 from 30,000, because because of the savings it would create by giving the people opportunity to put less money in superannuation. So you always see these sorts of articles come election time, and we're around the corner from an election, which of course means that let's go with a probable May date, right? But maybe April, more likely May. But if we look at that, what sort of superannuation announcements are we going to see, and how many of them will be linked to indexation style numbers? Will we see reintroduction of Div 296? Will we see any other sorts of things change as a result of the election? And I've got some numbers today where I'm going to talk through age pension indexation. When you look at the amount that the age pension has been indexed, when we're looking at CPI so the cost of everything else is going up 2.5%. I think the age pension amount, the indexation is 0.0 or 0.4. So, are we going to see some form of relief there from a government point of view come election time? We'll have to wait and see. So, yeah, it's important to understand that indexation doesn't always occur, and not all thresholds are indexed, and not all thresholds are indexed equally and in the same manner. So it's then an appreciation of having an understanding for how various amounts are indexed if you're getting asked these sorts of questions. And so all I've really tried to highlight here is the two primary ones. So the two that I guess give interest to most of us is the concessional cap, because the concessional cap leads to the indexation of the non-concessional, because that is 4 times concessional, and that is indexed in line with average weekly ordinary times earnings, but it only goes up when the index figure increases the current figure by at least $2,500. So it has effectively a base indexation level to say we won't increase, or this amount won't increase until the formula puts us $2,500 more or more above the current level, and then we round back down to that 2,500 position. So what we saw with the numbers that were released in December was we saw a factor of 1975. To get to 32,500, we needed to see 1993. Now, what's interesting when you go back and review these numbers over the past, X number of years, on sort of a history lesson, it tends to jump between 60 to 80 points sort of every financial year. So, I make the assumption there that we're going to see the contribution caps index on 30 June 2006. So from 1 July 2026, not 2006, 2026, we should see the concessional cap go up to 32,500, and therefore the non-concessional cap going up to 130,000. But for now, they're going to remain at 30 and 120. Transfer balance cap, unlike the contributions, is indexed in line with CPI. So that's why, because indexation, because inflation was so significant a couple of years ago, we saw that double hit where we went up 200,000 in 1 year. sort of the numbers now have reverted back to more normal indexation type based numbers. So again, we had a target factor for December of 137.5. We hit 139.4. So we managed to get that level to see the general transfer balance cap going from 1.9 million to 2 million from the 1st of July 2025. And of course, that has a significant impact on a number of key issues from a strategic point of view that we'll talk through a little bit further through the presentation. My guess, and again, might take it with a grain of salt because I generally do, is that the general transfer balance cap won't be indexed and subsequently at 30 June 2026 because we need to see that increase go up to 144.4. And normally, we normally see sort of between 3.5% to 4%. And that's, again, the target number that the government seem to always sort of be working around. So I would surmise from that we won't see the general transfer balance cap go up next year. And we'll continue to see this alternating between the general transfer balance cap and the concessional contribution cap. But we'll wait and see what arises out of that. So when we look at a bit of a summary of the thresholds, general transfer balance cap up to 2 million, the defined benefit income cap, which is a division of 16 of the general transfer balance cap, is going to 125,000. I'll touch on that a little bit later. And of course, that's significant given that not so many, but a number of self-managed super funds are really looking at whether or not to commute existing legacy pensions, and those legacy pensions are linked to those defined benefit income caps. And certainly that has relevance with regards to market-linked pensions based on how much tax people will pay because their income is going to be above that defined benefit income cap as their term shortens and their pension factor results in them having a much higher income to draw down in the final few years of their market-linked pension. So that's where that number becomes quite significant. Concessional, non-concessional, no movement there. CGT cap, we'll see that jump to 1.865. So again, quite a significant jump in regards to that. Superco contributions, we see a slight increase to the lower and upper threshold. And of course, the super guarantee, legislatively, unless we see some form of announcement from some form of government in the future, where we've hit the maximum super guarantee rate of 12%. So it took some time, but it's at that final position. So that super guarantee rate does have some relevance when we talk about a number of other issues with regards to contributions, and I'll come and focus on those when I talk a little bit about the contribution side of indexation versus the pension side. So the general transfer balance cap, we know it was ultimately introduced back in 2017 as a ways of ensuring that members of superannuation funds, or individuals of all superannuation funds, could only put a certain amount of their retirement benefits, their retirement savings, into the retirement phase, and then subsequently being entitled to receive the exempt current pension income deduction. So, the key thing about the introduction of the general transfer balance cap was it's all about this concept of tax concession. And, for those of you that have heard me present before, I'm relatively consistent in some of my, some of my sort of ongoing conversations about certain elements. That's a long-winded way of me actually saying that, the concept of superannuation based on the sole purpose test is to provide retirement benefits, right? So when you look at the introduction of the general transfer balance cap, what it is effectively saying is we're still not going to compel you to take a pension, despite the fact that the sole purpose test sort of pushes us that way, right? But there's no compelling argument to put your money into retirement phase. But when you do, you don't have to put all of it in. You're only going to put this amount in, and then that amount will be entitled to the exempt current pension income deduction. It's to me, it's still an interesting measure. It's a backward-looking measure because it takes us back to reasonable benefit limits, and I'm not necessarily suggesting that they were bad measures themselves. Should they have been abolished in the first place, where the outcomes are ultimately going to be pretty similar. But our general transfer balance cap plays such a major role now because it is linked to our retirement phase income streams, so how much money we can put into retirement phase. Quite amazingly, it's linked to access to the government co-contribution and the low income spouse offset, in the sense that a lot of the low tax and the low income earning opportunities that exist in superannuation, eligibility is based on you having less than the general transfer balance cap. And I think, it's fair to suggest that most people would be relatively comfortable in stating that most individuals entitled to the government co-contribution or for having a spouse with less than $2 million getting a $540 rebate by making a $3,000 contribution, most of those clients aren't clients that are in that sort of $2 million account balance. Yes, I would appreciate that you would have some individuals with significant balances with non-working low balance spouses, and so there's an argument to suggest that people are getting benefits they might otherwise not be entitled to. But I think most of the time, anyone on the government co-contribution and the low income spouse offset, are getting those entitlements because they have less money in super, and it's actually a tax incentive for you. So those are the issues. And then, of course, the bigger piece of the general transfer balance cap, beyond the biggest being the retirement phase stuff, is the non-concessional bring forward amount. So as we can see, this is indexed over a significant period of time. So we've seen it now for we're in our eighth financial year. We're coming up to our ninth financial year of general transfer balance cap. It took us a while to get going, to move from our $1.6 million up to 1.7, but as you can see, we're going 1.7 for 2, 1.9 for 2, and based on my prediction, we'll jump to 2 million for 2, and then the defined benefit cap sitting alongside of that is directly linked to that amount as well. So when we look at it from an income stream point of view, and this is where I think where the general transfer balance cap administratively becomes difficult. And for those that follow the industry closely and follow what's going on with, say, the SMSF Association and other parties, one of the key issues with regards to the general transfer balance cap is that it is proportionately indexed. So I've just shown you the numbers that are general in nature, so the $100,000 indexation levels. But that $100,000 is not then people that have utilized their general transfer balance cap, they don't avail themselves to that index level. So once you have locked in on a cap, that is your cap forever. If you've utilized the full amount, you lock in, and there's no access to indexation, right? So in a sense, that's a move well away from the old reasonable benefit limit system that did provide for the ability to utilize the indexation. And what they've created is proportional indexation, which is somewhat of a way to offset those increases. But the way that proportional indexation works is overly complex. And one of the things, getting back to my comment about the industry, is the industry have been asking for many years, well in fact longer than the introduction of the general transfer balance cap, the industry has been asking for access for other parties, so parties that are not the tax agent of the self-managed super fund, to be able to get access to such material, such information as is provided on MyGov, for example. So the proportional indexation is a calculation done by the ATO, but other than the member or the member's tax agent, because it's an individual-based thing. So the SMSF tax agent doesn't have access to that MyGov. The financial advisor doesn't have access to that MyGov, and so it's problematic in trying to operate in the SMSF space, where the SMSF industry and many parts of it, it's broader than the SMSF industry, but that's the world that we operate in, are effectively locked out from easy access, even if it's only limited access, easy access to vital information about that individual to be able to properly advise in this space. But the proportional indexation works to the degree that if you first start your pension after indexation, then you will adopt to that new index level as your personal transfer balance cap. So anyone starting a pension after the 1st of July 25 will have a personal transfer balance cap of $2 million. Anyone who has commenced a retirement phase income stream before indexation and they utilize the full general transfer balance cap at the time when they commence their pension, then they will, as I said before, they will not be entitled to any indexation of their general transfer balance cap. And then we have everybody in between, right? So we've got an individual who hasn't used their full amount of their transfer balance cap, then they will get proportional indexation every time there is indexation of the general transfer balance cap. And that proportional indexation is based on a calculation that requires you to identify the highest ever balance in the transfer balance account. And so, you know, commutations, partial commutations don't change that number, right? So the highest amount you've ever had will be that highest amount until you put more in, and therefore you increase it. So you identify the highest ever balance, you use that to calculate the unused cap percentage of the transfer balance account. And this is a rounding down process, you know, and I actually was doing some calculations for a workshop that I'm doing, and I was contemplating somebody who used or commenced a pension for 1.6 million when the general transfer balance cap was 1.7. Now that number, when you factor 1.6 into 1.7, gave a factor of 94.117%. The requirement is that you go, okay, well, you round that down. So you just bring that back down to 94. And then you subtract that amount from 100% to give you your unused cap percentage. And that percentage is what you apply to the indexation level when we actually get there. So if we use this example of Andrew, who started a pension back in 2022 for 900,000, had an unused cap space. So the cap was 1.7 at that point in time. So I basically used 52% of the cap with the round down calculation, gave an unused percentage of 48%. So when the general transfer balance cap was indexed to $200,000 on the 1st of July 2023, Andrew applied a 48% factor to that 200 to get an increase in the general transfer balance cap of 96,000. So his personal transfer balance cap went from 1.7 to 1.96. So he didn't get the full 200,000. Then a bit of activity occurred, and in that activity, he took some money out and put some more money back in. And with that more money going back in, it resulted in the unused proportion decreasing because he had actually used a little bit more of the money. And the end result being, we went from that 48% in the first lot of indexation down to 46% following the commencement of the second pension in 2023, meaning that on the 1st of July this year, when indexation applies, then Andrew will have a 46% indexing of the new amount, resulting in $46,000, meaning his cap's going to jump from 1.796 to $1.842 million. So in the standard game of super, you know, that calculation becomes fairly complex, and most people will potentially get that wrong. And if they get it wrong, because one, what they see is the general transfer balance cap. So, you know, individuals decide they're going to look at this sort of stuff on their own. They see that it was 1.6, went to 1.7, now it's going to $2 million. Go, right, well, I've only put in $1.6 million into my pension. I've got some more money, you know, I made a downsize or I did whatever. I've still got space. I've got cap space available to me, so I'm going to put that money in. Once they commence that pension, then they are going to have an excess transfer balance amount, and then they will have notional earnings attached to that, subject to the amount of time that money is sitting in the retirement phase. So if they have that money sitting in retirement phase, then the notional earnings will be calculated until that amount is commuted back to the accumulation. And when you commute, right, you'll need to commute the that excess transfer and put it back into the to the accumulation. Now, the reality of that is that I largely have dealt in the advice space and the accounting space, where people are at least conscious of how this works. So I put my hand up here and say that I actually haven't seen any excess transfer balance accounts, and I'm not suggesting that they don't exist, and I suspect that some of you may have seen them yourselves. But thankfully, unlike contributions, I haven't actually seen excess transfer balance accounts as the norm from an industry point of view, versus say when the contribution caps came in and people were just exceeding their cap left, right and center. We saw everybody doing it basically. Well, not everybody, that's a slight exaggeration, but it's not as prevalent an issue from an industry point as perhaps the excess contribution rules are. But of course, the other thing that happened when we had the transfer balance cap introduced was that we saw this restriction, or this consideration of the fact that we had in the industry, despite much lobbying, we had these complying pensions where the value of those complying pensions was such that from a capital point of view, they would result in individuals exceeding the personal transfer balance cap of $1.6 million. Now, this is where, unlike reasonable benefit limits back in the sort of the 80s and 90s and early 2000s, there was no capacity to apply for a higher general transfer balance cap, or no higher personal transfer balance. So nothing based on the fact that you had a compliant pension that complied with everything according to the rules back in the day. You then transition into this new system, and it would result in you having an excess transfer balance account. And so what they did was they introduced an income-based cap as well, which was our defined benefit income cap, which said, all right, well, instead of us continually issuing you with an excess transfer balance account assessment, asking you to commute that pension when the legislation doesn't provide you with the ability to commute those pensions, what we're going to do is say, if you earn more than this cap, and of course 16 was the factor they used, so if you earn more than the division of 16 on the $100,000 as it was in year one, but if you earn more than that, then it doesn't matter whether you have tax-free or taxable components within your superannuation pension interest. 50% of the income above that cap will be taxed at your marginal tax rate. So again, a little bit more different or more complex to the old reasonable benefit limit rules and other things. It was like any amount above this will be taxed at marginal tax rate, but only 50%, and it's irrelevant whether it's tax-free or taxable from a percentage point of view. So that's how the defined benefit income cap came about. And of course, one of the key things now is that we've got our defined benefit or legacy pension, I should use that term, our legacy pension amnesty. So our regulations that came in from effective from 7th of December, which mean our market link pensions and our lifetime pensions, because that's the reality of where 99.9% of these pensions sit, lifetime complying and market link pensions, they can now be commuted. Right now, we already had some commutation powers put in place for anybody that had commuted a pension post 2017, and commenced a market link pension that was excessive, right? Because if they did that after 1 July 2017, it would create an excess. So we've already got powers to commute an excess market link pension where the vast majority still stays in retirement phase, but the amount above that would be commuted. Those powers came in, legislation came in from August or April 2022. But now with this all-encompassing power to commute these pensions, it means that things like the defined benefit income cap are going to be amongst the considerations that we have when discussing with our clients whether it's appropriate to commute an existing legacy pension or not. So again, it's certainly the flavour of the month. The industry are really happy with it from an introductory piece, these regulations, but there are still considerations for for people to think through it. It's not just a standard, let's just stop all of these pensions. There certainly are elements that people need to work through. So one of the things that I wanted to touch on then from a strategic point of view, and again, without necessarily getting into a deep dive from a strategy position, and that's not the point of these webinars. It's more the thought process to go through, is with the general transfer balance cap indexing from $1.9 million to $2 million, does that mean we need to, or we should be talking to our clients about deferring the commencement of a pension from 1 year to the next? Now, again, from an indexation point of view, the difference between $1.9 million and $2 million is quite negligible, in the sense that if I looked at that 1.6 versus 1.7, it was about 6%. So it's not in the greater scheme of things going to be significant from a numbers point of view for the vast majority of individuals. But those who are there and abouts with their balances, so those who are sitting there and abouts 1.9, maybe just over 1.9, should they be looking at commencing a pension now, or should they be looking at commencing a pension after the 1st of July, when the cap goes up to 2 million, albeit that there's a crystal ball event in the middle of all that, which is valuations at 30 June, because there might be a spike in valuations and you come across the same issue of the balance is more than 2 million on the 1st of July, and which is exactly the same as a balance being slightly more than $1.9 million now. So, you've got your valuation considerations to contemplate there. So do we start pre-1 July or do we start post 30 June? Well, some of the things that we need to ultimately consider is from a CGT point of view, right? Is there some benefit? Like, is there a CGT event that's occurred during this year where the fund would benefit by applying some proportion of ECPI based on a late year commencement? That's going to mean a smaller exempt current pension income deduction under the pooled approach, the pooled investment approach, but that is then applicable to the income across the entirety of the year. So, by starting a pension on the 1st of April, 1st of March, whatever it might be, you're getting 3-4 months out of 12 months. So you're basically getting a quarter to a third of the income being exempt income with the fund, and then you can apply that across the entire year. There may be some benefit because of a CGT event that's occurred earlier in the year. The other piece is, because it's year one of the pension, the disregarded small fund asset rules, and we touched on them in our webinar. I think it might have been September, October, but the disregarded small fund asset rules suggest that if you're the first pension member in the fund, then in year one, you can always segregate the pension, because the way that disregarded small fund assets work is it's backward looking to see, did you have more than $1.6 million in the previous year, and were you in receipt of a retirement phase income stream anywhere, not just in the self-managed super fund, but anywhere else? If the answer to that is no, then you don't have disregarded small fund assets, which means you can segregate. Now, it might be short-lived, because you might get to the end of this year, have more than the 1.6, and not be entitled to segregate next year when you go back and reassess. But it could be critical if you've got an asset that you're contemplating selling down that has a large capital gain that could conceivably be segregated in this financial year, and having that tax element offset. Now, that, putting a value on that is difficult to do without knowing what your CGT position is. But anyone that is in a position, there might be a requirement to sell, there might be a desire to sell, and an offer is on the table now that might not be on the table, in 5 months' time, 4 months' time, or whatever. So by looking at it, are we better off looking to start a pension now to save on the tax liability, for the sake of having an additional $100,000 in pension later? Is there a better tax outcome by doing it now? So they're some of the conversations, because the standard piece is, oh, well, the cap's going up, so we're better if we've got more than 1.9, we're better off waiting, but it might not be necessarily the case. So there's sorts of things to contemplate. And similarly, the whole idea around locking away tax-free and taxable components now. So the whole estate planning piece, where you might be making non-concessional contributions and you want to lock them away, and you don't want any of the earnings in accumulation to be, or the taxable earnings in accumulation to be attributable to a particular amount. So you might look to start a pension by making non-concessional, start your pension, and then locking in 100% or whatever the number might be. But it's certainly a conversation piece that people need to be mindful of. Is there some form of estate planning consideration by starting a pension in the current year versus the next year, whilst you can isolate sort of tax-free and taxable amounts. So, you know, they're just some of the considerations to work through. So again, it's really about providing you with the avenues to think through, okay, what are we looking at doing here with regards to our clients? Are there opportunities that we can take on board to ensure that our clients sort of get the best result when it comes to commencing their pensions? So let's have a look at indexation with regards to contributions. So I think the first thing that I want to touch on is more of an administrative issue, but it's become more relevant. And again, those that have been coming along to these webinars for longer than 12 months, I spoke about this 12 months ago. It's possible that I spoke about it 12 months before that as well. But it's really this concept around the super guarantee, because one of the reasons that I like to sort of hone in on indexation as a subject matter is because we have this anomaly where the concessional contribution cap indexes on as I said, on a $2,500 base level indexation piece, which means it doesn't index annually. We've had, until this point in time, you know, for the last sort of 5-6 years, an evolutionary super guarantee that has gone up by 0.5% every year. We've also had maximum contribution base. Now, the idea of maximum contribution base is to say, when the super guarantee introduced, as I said, 92, 93, some of us were around when it was introduced and have watched it grow ever so slowly from that 2/3%, as it was back then, up to the 12% that we're seeing from next year, or from now. However, the key issue was, once the concessional contribution caps came in back in 2007, and more importantly, when excess contributions came in 2007, the Super Guarantee Act as such was effectively altered to say that super guarantee should not result in you having excess concessional contributions, right? So there should be no time when your employer does what's mandated of them and contributes to super, and you end up with an excess tax liability. So this concept of maximum contribution base was introduced to ensure that employers would have a maximum amount of your income, or of an individual's income, that they were required to pay super guarantee on. It's not to suggest that they can't pay more, but it would mean that if you earn above the maximum contribution base, which is a quarterly amount, and your employer contributes, they are not mandated contributions, right? So they're over and above the mandated contribution element. So the maximum contribution base was introduced to fix, based on the super guarantee rate, the level of contributions that an employer would need to make, which would ensure that you did not exceed your non-concessional cap. Right? Now, of course, that doesn't factor in things like the carry forward amounts. All that is based on the base cap, and that's currently $30,000. Now, that maximum contribution base is normally indexed in line with average weekly ordinary times earnings. And last year, that cap was $66,500. If we applied indexation to $65,500, and we index in line with a WOTI, then that number would be sitting around sort of $67,000+. When you then do a 12% contribution, so this is for next year, when you do a 12% super guarantee contribution on 67,000, it would mean that you would be contributing more than 7,500, timesing that by 4, being the quarterly amount, would result in an excess contribution. So they have an alternate formula which basically looks at both the cap, and it looks at the indexation of prior maximum contribution base to say, okay, well, what is the cap? What is the factor of that cap when we take into consideration a multiple of 4 months and an end result being that the super guarantee does not exceed that cap? And so what we've seen for this year, for the first time, is that the maximum contribution base has actually decreased. So it's gone from $65,000 down to $62,500. Right. So if we see a concessional cap increase, as I'm projecting for the 26 year, 26-27 year, then we'll see that maximum contribution base go up again, because the super guarantee will stay at 12%. And so you're not having these two competing sort of amounts moving. You're only going to see the concessional cap increase, not the super guarantee. So we'll sort of see, it's almost been a reset year. Next year will be a reset year of the maximum contribution base, right, which will then see it start to escalate again after that, based on the contribution cap escalating. So it is a bit of an anomaly and a bit of a different one from an indexation point of view, but it also leads to the other key issue with regards to super guarantee, and that is the issue of multiple employers. So super guarantee previously, or has always been a mandated contribution, and there were some small exceptions, for children under the age of 18, and part-time work for those over 70 or whatever. And so there were some restrictions in place that have subsequently been moved, and the 30-hour stuff, and that's all gone as well, and the part-timers. So now it's a mandatory contribution. But again, what they're saying is, if you've got one employer, then that one employer can't exceed or won't exceed the cap, because we've introduced the maximum contribution cap. If you've got a second employer, right, and that second employer is going to result in you having excess because you've got this one employer that contributes over and above the cap, then there is a mechanism which allows the employee to apply to get effectively an exemption certificate for their employer, that they then present to the employer to say, you don't have to, right, as of now, you don't have to present, you don't have to pay super guarantee for me, because it will result in me exceeding the cap. So it's a two employer requirement, but also you have to apply, the individual has to apply to the tax office, and you have to apply 60 days before the start of the quarter that exemption is sought for. So it's a scenario that's only valid per year. So it might be that contributions in the first quarter are not going to exceed the cap over the year, maybe because the first employer is not paying up to the maximum contribution base, you're earning slightly less there, so you've still got some contributions going in from your second employer, but then when you start to add them together, the amount's going to go up. Then you can apply for an exemption to the commissioner. So the super guarantee, is not just a straightforward, here you go, here's 12%. There are other factors that we have to contemplate, particularly for our high income earners and their eligibility for super guarantee versus excess contributions, and then factor into all that Div 293, which of course means for anybody at the maximum contribution base, their maximum contribution base is now $250,000, which is the Div 293. So $1 of super guarantee is ultimately going to be taxed at 30% anyhow under the Div 296 regime. The other thing, of course, is that indexation impacts non-concessional contributions. Now, it's not indexing, the caps aren't indexing, so we're not seeing a change in our factor there. But what we are seeing is, from a total super balance point of view, we move from that 1.9 across to the 2 million. So based on our total super balance at 30 June 2025, if we've got $2 million or more, then our cap is nil. If we've got 1.88, so again, we take off the 120, then we take off the 240, and then we take off the anything below that, we get the full 360. And so where the non-concessional cap is quite beneficial is that we we have the situation where somebody's total superannuation balance may have been such that they weren't entitled to fully utilise their bring forward amount. So this captures people who have triggered a bring forward in a previous year, but then because of the contribution they've made and because of growth, their balance then pushed them above the general transfer balance cap, resulting in their cap for a year being reduced back down to nil. And so if you look at the example of member A here, who had a total super balance of 1.67 at 30 June 2023, made $150,000 contribution. So they triggered their bring forward amount, but they didn't have the full capacity to contribute, triggered the amount, but then come the next 30 June, their balance was 1.9 million, right? And so with it being at $1.9 million, because they had a big year from a growth point of view, it meant their cap in the next year was nil. So they effectively had this $180,000 sitting in limbo that they couldn't contribute to super because their total super balance had gone above the 1.9. Move forward to 30 June this year, and their total super balance is below $2 million. I've got 1.95 there as the example. Their cap next year is not the single year cap. Their cap is the remaining balance of what's left from their bring forward amount. So in this instance, the cap for the 25-26 year, this member would be $180,000. So that's significant because we've had that indexation, that increase of the general transfer balance cap. Is providing us that opportunity to contribute amounts that we may have missed out on because the balance of the fund grew. Of course, we're locking in to the cap that we had a couple of years ago, the 330. So that contribution kicked off before the caps went to the 360 amount. And they're just issues that we need to make sure that when we're talking to our clients about that they understand that the concessional, the non-concessional cap, and the general transfer balance cap are linked from an accessibility point of view, but the numbers are locked in based on when a process starts. So the number of non-concessionals is locked in the day you start making that non-concessional. So that's the 3-year rule. So again, all these key considerations that people have to think about because we deal in a world of indexation. So going from those with $2 million to those who are less likely to have and indeed don't have $2 million in super, particularly from a deeming point of view, or from a vast majority point of view, is the concept of the age pension. And look, as I said before, I touched on this a little bit earlier when I said from a federal budget point of view, I don't have a crystal ball to know what they're talking about from an age pension. But if we're seeing indexation numbers that we've been seeing from so a CPI stuff that we get from the Bureau of Stats versus indexation that we're seeing from an age pension point of view, when we see the number, say there from a couple getting an additional $7 a year for an individual getting an extra $5 or $4 or whatever per year, when everything else is going up, that seems to be fairly insignificant. And so, where and I appreciate that it's a bit of a step away from self-managed super funds, but the reality is that a lot of self-managed super funds do have and it's their only asset other than their house, and so you're going to have couples with super balances well and truly less than $1 million, or as we've got there, 147,500, which is our maximum asset level for couples, 697 for a single. You're going to have people that have less money than that, so they're going to be eligible from the assets test point of view, potentially to get partial age pension. But then when we look at the income thresholds, and you've got 3,800 for a couple and 2,500 for a single person, again, that's our where we cut out access to it, because we apply a deeming basis to the value of our assets inside a super. These numbers, whilst they're not significant, more and more people will start to qualify for it. Then when they qualify, what are they getting? And that's when we look back at that 1149 number. And so, the benefit they get for having lesser amounts of money in super and these other things is not necessarily proportionate with how the rest of the industry is growing. The other thing that I certainly am interested to sort of see from a budget point of view, and the federal budget in theory is meant to happen next week. Who knows what's happening? I saw that the Treasurer made an announcement to say that he was going to be announcing a deficit in the budget. So will we get to the budget, or will an election be called before that? We'll have to wait a few more days to find the answer to that. However, one of the budget announcements that has occurred over the last few years is the fact that the deeming rates on the income for age pensioners. So one of the, I guess, benefits that the government have said they've provided from an age pension point is a freezing of the deeming rates. Now they are frozen until the 1st of July. So we've got record low rates of 0.25 and 2.25. But of course, that starts to hit harder if those deeming rates start to go up as well, because then the income test starts to become far more relevant with regards to a lot of the clients. So right now, under the lower deeming rates, most people who have money sitting in super, and I'm not talking about our grandfathered clients, our pre-2015, but most people from a deeming point need to have a significant amount in super, right? Certainly more than the current asset test to fail from a deeming point of view. So that deeming number is going to be significant. It will be indexed. The actual threshold for deeming point of view will be indexed come the end of April, because we get our CPI figures from the March quarter to up that 62,000 odd and the 103,000 odd. But then the actual percentages themselves of deeming, that's a critical number that we want to wait and see sort of what comes about from both the federal budget, the 30 April indexation numbers, and then any subsequent budget that might occur from an election, right? In the instance that there is potentially a change of government, or indeed a hung parliament, does that mean that they need to reconsider things, and do we get a situation like we've had before, where we get a second budget for the year? So there'll be a number of key issues for us to be able to review and work through over the next sort of few months. But I think where this is also important is when we look at, say, the Commonwealth Seniors Health Card thresholds and that as well, is and I go back to the legacy pension commutations. We're still waiting from the government's point of view to get our debt waiver legislative instrument to say that if you cease your legacy pension, it will count towards the asset test, but you won't be reassessed over the previous 5 years. You'll just potentially lose benefits moving forward, but no clawback of any subsequent debt. We're still waiting for that. But of course, where these numbers and the numbers before the asset test numbers become relevant is saying, well, if you've got a defined benefit legacy pension, what's the actual value in that? Because a lot of people that set them up would have set them up for a few $100,000. I'm not talking about the $1 million+ clients, because they had these pensions for other purposes, but those with smaller balances that maybe have 200,000 to 300,000 sitting inside super, or as a couple they might have 3 to 4, then they're still going to be under that $1 million. So even by losing it, once that debt waiver comes in, by losing the asset test exemption, they're still going to qualify in part for the age pension, and if not, then the Commonwealth Seniors Health Card. So there's a number of things to be mindful of there. So then the final sort of indexation number that I want to talk about, and we won't see this until May, which means we won't see this until probably the second or third week of June. But that is our RBA indicator lending rates, right? Because we know in May 2024, the standard variable housing loans rate for investors went from 8.85 to 9.35. And that, of course, is the rate that is used for PCG, for limited recourse borrowing arrangements for related party loans. And so 9.35 is the current rate of interest that they have to pay. The current rate, so the February 2025 rate, which was released a week ago, is 9.20. right? So if we see nothing between now and May from the RBA with regards to more reductions in interest rate, then we know that the LRBA related party loan in conditions based on the PCG 2016-5 will be 9.2%. However, the commercial lenders, so I was doing this presentation only a month ago, or this slide only a month ago in our, a few weeks ago actually, and the commercial lending rate was 6.99. Well, the commercial lenders have already dropped their rates, right? So commercial lenders are already starting from 6.74, right? A lot of them are hovering around that 7% mark. But what we're seeing here is that there is already a 2.5% differential between the LRBA rate for related party loans based on the ATO safe harbour rules versus what you can get commercially. So clients with related party limited recourse borrowing arrangements, if they haven't already looked at blowing these up or looking at refinancing them last year, then if we're not going to get a significant decrease, and I mean, I wasn't sure whether we'd get any decrease, but the fact that we've seen one, will we get another one before May, would suggest that 9.2 versus the 6.7 or whatever means we seriously need to look at either going and getting an offer from a commercial lender that we can then match from our related party loans, or actually changing lenders and looking to move outside of the existing framework of the PCG related party loan. So there's key elements with regards to limited recourse borrowing arrangements that we won't have finalised until just before the end of the financial year, but will have significant impact on any clients who are still paying paying down their LRBAs based on these variable rates. So key one that we don't have strategically the indexation number for yet, but it's not that far away. But based on what we're seeing, anything from the tax office is to me going to be slightly problematic in that regard. So to summarise, to wind things up for today's session, as I said before, when we're dealing with the contribution caps and general transfer balance cap, they're not in the line. I think we got excited because in 2021 we got them all indexed together, right? And so it's like, okay, this is great. If they can always move along operating on the same indexation, then the world's a lot easier place to operate in. And that was a one-time event. It will happen again. We will have indexation of both of them at the same time, but it just means that we have to make sure we're in tune with what is being indexed at any given point in time. But despite not having any indexation, there is still an opportunity for us to review our existing, anything to do with salary sacrifice. And again, strategically, I think I've run through it with you before, the whole preservation age 60, and transition to retirement income stream / salary sacrifice, we should have been reviewing that this year anyhow. And so if we haven't been reviewing it, then now's the time to start reviewing salary sacrifice arrangements and TRIS for next year, because there is inevitably, for the majority of people, going to be a tax saving across super and personal tax versus just a salary and minor contribution amounts. The numbers ultimately don't lie there. So there's opportunities that exist. Non-concessional contributions, so there may be a greater opportunity scope to contribute because of that higher general transfer balance cap. But the catch being that you're locking yourself in, or you're currently within a 3-year bring forward people. So we need people are currently within a 3-year bring forward period. So we just have to be mindful of that. We need to look at our related party loans. So that last piece, I think, is still critical, because there's still plenty of people with LRBAs out there. But we also need to contemplate now this whole piece in the last, as we approach the last quarter of the year, do we start a pension before or after indexation? And ultimately, it becomes a bit of a tax question, right? It becomes a question of what's the best tax outcome for our clients there. And then finally, our age pension and our deeming rates. This is really in preparation for moving forward, but also preparation for the decision about legacy pension commutations and that as well, is to see what the impact of any changes to deeming is going to be as a result of indexation or changes in government policy moving forward. So look, just a real quick one from me. I run these webinars monthly for and on behalf of SuperGuardian. SuperGuardian are an event partner of ours in our upcoming SMSF days. We're going around the country. We're starting this week. I'm flying off to Perth tomorrow, but then we've got Adelaide, Melbourne, Brisbane, Sydney following that. So we've SuperGuardian have been on board for this, I think, the third year supporting us. So we're very thankful for that. But if anyone is interested, it's a full day, basically eight CPD points that get provided there. We work through a whole case study, a lot of scenarios. So particularly a lot of the key issues around pensions and failing pension requirements and other things are key to this year's SMSF day, and also the tax considerations for self-managed super funds. What have we got coming up? 15th of April, interactive contribution strategies in an SMSF. 22nd of May, we're doing exiting legacy pensions and reserves in the self-managed superannuation fund. And then on the 17th of June, we've got our end of financial year checklist webinar. So look, thanks for joining me today. I look forward to catching up with you in April. You will, of course, get your CPD and a copy of the slides sent through. So thanks very much. I look forward to catching up in April. Have a great day.